Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of the Russell 2000 ETF, ticker symbol IWM. As I zoom in here, you'll see that I left my lines on the chart from last week. This diagonal line ended with a target of $180.72, and today, towards the end of the day, we hit that target precisely and then started to bounce. I believe the bounce at the end of the day was a result of short covering into the close and into the weekend. And so while that is a hit for the target number, we have also hit on all of our targets, including the VIX from last week's market report. Now, what does this mean for next week? Well, this line right here is something I've been talking about. That is a former support level that is now most likely going to act as resistance. There's a concept that I talk about all of the time with our members where support here, once broken here, generally turns to resistance. It's a role reversal concept. It's nothing more than, again, when the buyers come in, the buyers eventually give up, fail to hold support. Then when we get these rallies back up to the former support level, we generally get the zigzag pattern, also known as an ABCD pattern. Now, with that said, let's take a look now at what the forecast will be for next week. And again, I do believe that we'll see just a little bit of a rally from here. I think we could go up to test this support level next week. We'll have to see. That might happen early on. And then again, it might happen towards the end of the week. It's really hard to tell because right now, as the market is going through this transition, it's more or less a step-down pattern. I talked about this level up here around 210 that stayed in place for a good long time. And if you recall, in following along with my market reports, I warned all of our option traders that once we broke below that support level, we would reverse all of our positions and go negative delta or stay more bearish in the overall positions that we held. Now, the same thing applies. Now that we're below this support level of 187, 188, we continue to keep our bearish stance, but from time to time we'll adjust our spreads. If I think we're going to rally next week, we might decide to take some profits on some of the short positions we have or make some adjustments on the spreads that we have. And each month I give an alert out, which is an expiration week alert to our members, giving them guidance and how to make these adjustments. So again, that's for IWM. Upside target is 185.98. Now let's take a look at the diamond, ticker symbol DIA. This too, we hit the target precisely on Monday, bounced off of this support level. See this support level right around 325.98. Rallied up to the moving average that held as resistance and then came right back down, closing very close to my target. We did hit that target precisely again, second time in the week that we hit that target of 325.98. Now again, this will most likely follow suit with IWM. I do believe that next week we'll see a little bit of a bounce, not a big bounce, but enough of a bounce to maybe give some false hope to those who are in the buy and hold camp. Remember, May is the month where many investors sell in May and go away. I talked about that last month. And so this bounce, again, I think is going to be temporary. I'm not going to be doing a two-part forecast. I think I'm just going to keep that in place. Again, at 332.52. So that could be, almost 400-point rally from where we closed today on this Friday. So that is the diamonds. Now, if we take a look at the Qs, ticker symbol QQQ, again, we broke out below this support level here, hit my target precisely today, and notice what's happening with the volume down here. See that lower volume? Well, when you see prices dropping with lower lows and lower highs, and then you see the volume start to drop, that tells us that the sellers are starting to lose some of that momentum on the sell side. So again, with the Qs, I do believe we're going to bounce and go right back up to that former support level, which again might hold. I say might because it's a little bit different than the diamonds. We have a resistance level up here closer to the moving average, but I'm going to play it safe on the bounce and put a higher target here at 317.17. See in that data box that pops up right there, it says end at 317.17. Now the date on that is May 11th. Something that's very interesting, one of our members, whose name is Tom, for his privacy I'll keep his last name anonymous, but Tom pointed out that Monday is a Russian holiday, and it's called Victory Day. They're celebrating their victory against Germany in 1945. But it could be very interesting to see what happens on Monday with Russia and Ukraine. I'm not going to go out and start forecasting any victories on any side of that war, but it would be interesting if Putin came out and maybe raised a flag of, victory flag of some sort and give some relief to the market. The inflation problem is a very big problem. It's not going away. I'm going to get to that in a minute. But this could be a very interesting week next week as these coincidences, if you want to call them that, are going to be popping up. So again, for the Qs, 317.17 is my target for next week. Now, if we look at SPY, this is the S&P 500 ETF. Again, we hit that target on Monday precisely. You see, this was Friday right here when I forecasted lower. My target for the spiders was 405.67. Came right out of the gate on Monday, traded down, hit that gap, bounced, hit resistance up here at that moving average, which this is a key support level that was broken, and it reversed its roll. See how I draw that horizontal line? It reversed its roll, turned to resistance right there. And now the 20-period moving average, which is that blue line, that now is acting as resistance. So I do believe that the spiders are going to make an attempt to go up, maybe all the way up to that moving average. And I'll drop that line right there with a forecast of 424.87. Remember, as the price is now trading below that 20-period moving average, the 20-period moving average is going to drift down over time here. So that price will most likely meet up with that moving average. And at that time, again, I do believe that that will hold as a resistance area right there. So again, to reiterate, the price target for next week on SPY is 424.87. Now that brings me to the VIX. My target was hit again on Monday right here. See, we had this shooting star right there. Target for the VIX was 35.36. We hit the target on Monday, and today came within 2 cents of that again, testing that. That seems to be a resistance area right now. This high is a resistance for the VIX. And notice this long shadow above the candle, that's known as a shooting star. That is bearish. Believe it or not, that's bearish. When you see these shooting stars show up, it means that the buyers came in, tried to push it to the highs, but the sellers came in and pushed it down from the highs. So that tends to be bearish. Now, 80% of the time, prices drop, so I'm going to go with those odds. And remember, the VIX, for the most part, is inversely related to the S&P. So I believe that the VIX could pull back to this moving average. Remember, the moving average is going to drift up now. So my downside target for the VIX is 27.94. Now, I want to bring your attention to something that I find, again, most interesting. Last October, see the dates here, October 7th. Last October, I began intensifying my reports on the shipping container problem and what was happening with supply chain issues. This is an actual presentation I gave in October of last year. And before that, at the beginning of 2021, I started reporting on the gridlock that was coming out of China with the ports. Again, I'm just kind of highlighting some of the articles that I talked about in October of last year. And I brought everyone's attention to this right here, where the ports in the U.S., the major ports, were experiencing congestion issues and delays. And these color-coded dots right here, you can see on the scale, means 71% of that congestion was taking place in these major ports in the U.S. And I believe that what we're seeing now is far much worse than what we had last year. And my thoughts about this with regard to Fed action or lack of it is that it doesn't matter at this point how much the Fed is going to increase rates. That's not going to stop the inflation problem that we have, because I think what the Fed is doing is they're trying to hammer a nail with a screwdriver. They're using all the wrong tools at the wrong time. They basically painted themselves in a corner, and they're not going to get themselves out of it, because the inflation problem is going to be because of supply chain shutdown. Now, this is a most recent GPS chart right here. Take a look at this. I'll try to zoom in a little bit. These dots represent GPS tracking of shipping containers in China. This is a Chinese program, by the way, that uses satellite technology to track the ships. And you can see these dark circles are ships that have been sitting out there for some time. These green circles are the ships that are trying to get out of port. This is not a gridlock. This is a complete shutdown. This is a dam, if you will, of the shipping lanes. And so you could think of this as China's intentional attack on the U.S. economy. I believe that's what it is. I think the COVID lockdowns is not so much going to hurt China as much as it will the U.S. And I think this is all intentional, believe it or not. You could believe what you like, but that's my beliefs and what I'm gathering in the data and the news headlines. But this is a fact right here. These are the ships that are just basically moored out there. They've run out of anchoring spots, and they're just drifting around in the sea out there. So that is a big problem that I think is only going to get worse. Now, if I go back and look at the Dow Jones Industrial Average over a monthly chart right here, you can see that we are already opening up May. See this candle right here? That May candle is representing a monthly interval, and we are now officially down below that 20-month moving average. I think that moving average is going to act as a major resistance moving forward, and this rollover effect into the bear market is only going to intensify. Remember, a couple of weeks back, I was talking about the 3 phases of a bear market. The first phase is where we break the moving averages, we break the trend lines, we keep going lower. Second phase is when we usually get a bounce. I think we're still about 8 to 9 months away from that possible bounce, occurring in phase 2 of the 3 phases. And then after that bounce, which I think is going to be very minor, I do believe we're going to quickly ramp up and get into phase 3 of the bear market, which is where the capitulation usually takes place. So we're still, I believe, at least a year to a year and a half away from that total capitulation. And if you're in that buy and hold crowd, this could be a very stressful market for you. For our option traders, let me just tell you something. They're having a field day right now. And if you'd like to learn how to trade options the way we do with spread trading, we're doing very well right now in the down market, then just contact Market Rebellion and plug in. I have a free webinar coming up here in about a week or week and a half, and that costs absolutely nothing to listen to me through Market Rebellion. We're doing a webinar. Contact them, get the link, and then you could take it from there as to whether or not you want to learn how to trade options. If you're a more sophisticated option trader, then we have those more sophisticated spreads for you as well. In other words, there's something for everyone here, and I'm doing my very best to try to help people make money in this down market and alleviate a lot of that stress that's associated with, that buy and hold strategy in the down market. So you have a great weekend, and we'll talk to you soon. So long.